Altcoins have been in the dumps for a while now. Now that means no one's buying them. So where did everybody go? Bitcoin hit a new all-time high over 126K last October, and if you've been around for previous cycles, you know what's supposed to happen next. Retail floods back in, rotates profits from Bitcoin into Ethereum and then into other alts further down the risk curve, bringing forth the green days where everything pumps together. And that's how the playbook has worked, except this time that did not happen. And the more we dig into why, the less likely this is just a delayed cycle, and the more it looks like something permanent. Which means if you're holding altcoins waiting for your turn, that should worry you. In every previous cycle, the fuel for altcoin rallies was retail money, regular people speculating. So where are they? Coinbase monthly transacting users peaked at 11 million in Q4 2021. Despite Bitcoin making new all-time highs, we're currently sitting at around 9 million. That is down 20%. But the user count actually understates it. Retail trading volume on Coinbase peaked at 177 billion in Q4 2021 and collapsed to 59 billion by late 2025. That's a 66% drop. Meanwhile, institutional traders now make up over 80% of all volume on the platform, up from around 70% last cycle. And when institutions dominate the flow of capital, it changes where that money can actually go. The old cycle pattern that we were used to, where profits move from Bitcoin into Ethereum, then into blue chip alts, and eventually down into smaller tokens, has weakened a lot. The capital coming in today looks different. It's mostly institutional money entering through ETFs and other regulated products, and it tends to stay concentrated in Bitcoin and a small group of large caps. It doesn't trickle down into smaller tokens the way retail flows used to. And the biggest pipeline for new money this cycle has been spot Bitcoin ETFs. Since launching in January 2024, US spot ETFs have pulled in tens of billions of dollars. BlackRock's IBIT alone now holds over 700,000 Bitcoin. These ETFs are actually majority held by everyday investors, not just big institutions. But it doesn't matter who's buying. The product only holds Bitcoin. And you can't rotate an ETF position into a mid-cap altcoin. You either hold it or you cash out. So all of that capital, whether it's a hedge fund or just someone who wanted Bitcoin exposure without dealing with a crypto exchange, largely stays inside Bitcoin instead of flowing into the rest of the market. So if Ethereum, with its massive DeFi ecosystem and its own ETF inflows, can't keep pace with Bitcoin in this setup, then what does that tell you about the outlook for smaller tokens? Now, does this mean that retail just suddenly stopped speculating? Well, absolutely not. But they may have found better places to do it, and that is potentially the bigger problem for crypto. In 2025, Americans bet roughly 167 billion on sports. That is up from about 150 billion the year before. Prediction markets went from niche to massive. Polymarket processed an estimated 21 billion in volume, up from 9 billion the year before. Kalshi hit 17 billion after doing barely 300 million in 2024. Now, we can't say for certain this is where crypto's retail money went, but the growth curves are hard to ignore. These platforms exploded during the same window that crypto retail participation collapsed. And they're also going after the same type of person: young, risk tolerant, lives on their phone. And they also scratch the same itch in different ways. Prediction markets give you that I am smarter than the crowd rush with the same lottery ticket upside. Bet on Fed rate decisions, election outcomes, whether TikTok gets banned, and you get your result in days or weeks instead of holding some token for years, hoping the team eventually ships a product. Sports betting wins on pure simplicity. A few taps on DraftKings with Apple Pay and you're in. So compare either of those to navigating wallets, seed phrases, gas fees, and cross-chain bridges where one mistake means your money is gone forever. When the speculative itch is easier or more satisfying to scratch somewhere else, people will go somewhere else. But it gets worse. Even for the people who did stick around, the market has become incredibly extractive. Here's what we mean. Tokens launched in 2024 and 2025 came with the vast majority of supply locked and scheduled for release to insiders who got in at prices dramatically cheaper than retail. You would buy at the public listing price, and then every few months a wave of supply would unlock from VCs who paid a fraction of what you did. The result? A huge proportion of token launches ended up below their listing price, many down 70% or more because they couldn't attract the billions in new liquidity required to maintain their prices. And that is just the slow version. The Trump meme coin showed what happens when the same insider retail imbalance plays out all at once. The meme coin peaked at nearly 15 billion market cap and then crashed over 90%. Two Trump-controlled entities held 80% of supply. Reports show over 700,000 wallets suffered combined losses of around $2 billion in just the first few weeks, while the project's creators extracted hundreds of millions in fees.
We're gonna win so much, you may even get tired of winning.
So when things like that happen at the highest level of visibility crypto has ever seen, you cannot blame retail leaving to find greener pastures. Now, zoom out to the supply problem. We went from roughly 1,000 cryptocurrencies during the 2017 ICO era to literally millions in 2025, with launch pads minting tens of thousands daily. In past cycles, everything could pump because there was enough money and few enough tokens. In 2025, millions of tokens are competing for a shrinking pool of retail money, so the math does not work for most altcoins anymore. Okay, so we've laid all of this out. Where does that actually leave the market? The way we see it, the market is fractured into roughly three worlds that don't really interact the way they used to. Bitcoin as the clear institutional asset, plus a handful of others like Ethereum and others that are getting their own ETF products. Institutions buy these and hold them the way they'd hold any other long-term investment, and that capital mostly stays there. It doesn't rotate into anything else. Then meme coins, pure speculation, no pretense. Nobody's pretending a dog coin is going to revolutionize finance.
To the moon!
And honestly, retail gravitates toward that. Not because the odds are better, you can absolutely get wrecked on meme coins too, but at least you know what the game is. And then there is everything else. The utility tokens, the infrastructure plays, governance tokens, and so on. And the uncomfortable truth is that the biggest channels institutions use to buy crypto, ETFs, regulated products, don't cover these tokens. Retail won't buy them because they've watched these tokens bleed for months as VCs unlock and sell. So these projects need buyers to survive, but the two groups that used to be those buyers have both left for different reasons. Without a new source of demand, a lot of these tokens are facing a slow bleed with no floor. Now, we could be wrong about all of this. Maybe liquidity comes back and a new wave of retail speculation finds its way back to crypto. It has happened in previous cycles, but every structural ingredient that made those previous altcoin seasons work, the retail participation, the rotation from Bitcoin into alts, the limited token supply, every single one of those is either gone or fundamentally different this time around. So, are you still waiting for altcoin season, or are you starting to think this market just works differently now?